In this video, we'll look at the key differences between securities lending and sale and repurchase agreements, more commonly referred to as repo. What is the objective for each transaction? In securities lending transactions, an investor needs to borrow a stock or a bond as part of a trading strategy. In a repo transaction, the investor is trying to borrow cash to satisfy the liquidity requirements of its daily operations. Who does it? The two key parties to securities lending are the investor that owns the securities, like pension funds or mutual funds, and the trader that wants to borrow the securities, often a hedge fund. Agent lenders arrange the loans on behalf of the investors, and prime brokers act as credit intermediaries to the market on behalf of the hedge funds. Repo transactions, though, are more straightforward. You have one institution that has a surplus of cash and another institution that needs to borrow cash to fund their operating needs. Many market participants could be cash lenders or cash borrowers on different days. Who earns the fees? In both cases, the lender of the scarce asset collects the fees. In the case of securities lending, the investor that lends the stock or bond earns a rental fee paid by the borrower. For repo, whichever party borrows the cash pays interest to the lender, just like any other cash loan transaction. Who gets the extra collateral? In securities lending transactions, the party that lends out the stock or bond gets extra collateral from the borrower. For example, for $100 of loan stock, they might get between $102 and $110 of collateral. In a repo transaction, the cash lender will give cash that has a lower value than the market value of the securities provided by the borrower. For example, the cash lender might be lending $98 and receiving $100 of collateral. In repo transactions, the most common security used as collateral is government bonds. How long do the transactions last? Securities lending transactions are usually traded on an open basis, meaning that the lender can ask for the shares back at any time, and the borrower can return the shares whenever it decides it no longer needs the borrowed securities. Repo transactions, though, have a fixed maturity date. These collateralized cash loans can be for as short as an overnight loan out to longer than a year. Most repo transactions, though, are 1 month or less in duration, and the most common transaction is an overnight loan. When are fees paid? Securities lending fees accrue on a daily basis throughout the month. Then, at the end of each month, a fee statement details what is owed by the borrower, and fees are collected in arrears. For repo transactions, the interest payment is made at the maturity of the trade. In summary, then, securities lending is about the need to borrow securities, whereas in repo, it's about the need to borrow cash. The party providing the scarce resource in each transaction earns the fees and gets the excess collateral. So for securities lending, the stock or bond lender gets the fees and the extra collateral, whereas in a repo trade, the cash lender gets additional collateral and earns interest on the cash loan. Securities lending has an undetermined date when the trade is executed, while repo trades have a fixed maturity date agreed at the time of the trade. And finally, securities lending fees are collected on a monthly basis in arrears, and repo interest payments are made at the maturity of the loan. There you have it, the differences and similarities between securities lending and repo.